Welcome to this session on personal financial planning. In this session, we will explain what personal financial planning is, what the constituents of a personal financial plan are. So, all of us spend a part of our income on regular consumption spending and we save the remaining, and we invest our saving in different instruments. So, the objective of personal financial plan is to identify the financial goals and to prepare a plan of organizing spending, financing if the income is not adequate to meet the spending, and to invest the savings to achieve the defined goals. We can take the help of an advisor to prepare the personal financial plan. As I mentioned earlier, we need money for regular spending and also to meet the unforeseen contingencies. So, we need to keep some money in bank savings account and liquid investments such as fixed deposits and money market mutual funds, so that we can withdraw this money as and when we require it to meet any spending needs or unforeseen contingencies. And investments are said to be liquid if they can be quickly and easily converted into cash. The surplus over and above what is required to meet regular daily spending needs is available, let us say, for a short period of less than 1 year, can be invested in these safe and liquid instruments. And we need to borrow if spending during a particular period exceeds the income. We also need to decide the choice of source of borrowing and the repayment schedule. So, we need to have an emergency fund to take care of unforeseen contingencies such as temporary loss of job, that is when individuals are moving between jobs. So, there is a temporary loss of income and one has to have adequate money to take care of the spending needs during that period. Loss of there could be loss of earnings due to accident, medical emergency, etc., and we also need to have money to take care of our spending needs during such periods. One may also need education loans for higher education and mid-career education such as executive MBA or EMBA. Individuals after spending 8 to 10 years in a company would want to add to their skills by going through a structured executive MBA or EMBA program, other such executive master's program, and these programs are quite expensive, and hence one needs to look for education loans to meet such needs. We also have to plan for our retirement, and hence we need to invest in a retirement fund. So, you may invest a portion of savings in pension or retirement funds to take care of the spending requirements during retirement when we do not have regular incomes. There are also term insurance plans which will take care of family expenses if something were to happen to us, God forbid. The life cover can be 10 to 20 times the annual income, and the actual premium will depend on age, income, health, etc. We also need to buy health insurance to take care of medical expenses unless your company takes care of such needs. And the health insurance premium will also depend on age, family size, health record, diseases covered, etc. General insurance companies which sell these policies are rated by rating companies based on their ability to pay the claims. The IIIA rating is the highest rating. This would help in selecting the insurance company. So, at some point in time after we start working, we also have to think of buying a house, and our savings may not be adequate to finance the purchase of house, in which case we have to apply for a home loan, and we may also need consumer loans to finance purchases of computers, cars, etc. And we need to set aside amounts required to pay the EMIs or easy monthly installments, because our take home salary will go down by the amount of the EMIs. And if we have adequate amounts at some point in future, we can decide to prepay these loans depending on the costs of doing so versus the benefits of doing so. We also have to plan for educational expenses of our children, and there are children's growth plans from insurance companies. So, after taking care of all these requirements, if we still have adequate savings, we can invest those in a portfolio of bonds, debentures, equity shares, mutual funds, etc. If people are risk averse, they may invest in bank deposits, bonds and debt mutual funds, because these are relatively safe investments. And if people are willing to take a little more risk, they can invest in a diversified portfolio of equity shares and or growth mutual funds, which invest a larger proportion of the amount collected or the corpus in equity shares. Bonds and debentures are also rated by rating companies, and these ratings will help individuals select the bonds based on their safety or the ability of the companies issuing those bonds to honor their obligations in terms of paying interest and returning the principal on time. And AAA rating assigned by rating companies indicates higher safety. There are three types of mutual funds, namely growth funds, balance funds and debt funds. And debt funds carry the lowest risk, whereas growth funds carry the highest risk. There are also index funds which will try and mimic stock market index, which will have lower fund management expenses. And these mutual funds invest in a diversified portfolio. We as individuals have small savings, and hence we may not be in a position to invest in a diversified portfolio, whereas mutual funds collect such small savings from a large number of investors, make it a larger pool and invest the same in a diversified portfolio. So, by investing in a mutual fund, we as individuals are indirectly investing in a diversified portfolio of stocks, bonds and other assets. And mutual funds are also rated based on their past performance by rating companies. Amount of savings or wealth to be invested in different instruments will depend on each person's risk profile, context, etc. The risk preference also will change with age. Younger people are willing to assume relatively higher risk, whereas older people are not willing to assume higher risk. Requirements of regular income versus growth also depends on age. Younger people would prefer investments that offer growth, whereas older people may prefer investments that offer regular income. There is no one size fits all approach to personal financial planning. We also need to review and make changes to plans if required at regular intervals. The advisor will give us the plan based on our goals, but the decision to plan our spending, savings and investments is entirely that of the individuals. So, one has to be very careful while finalizing the plan and the investments. One has to keep in mind the defined objectives of the plan, and if the plan is achieving those objectives or not. Thank you very much.